Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So maybe you guys have heard of Ark Invest. You know, the folks who used to get laughed off stage and laughed off set when they shared what appeared to be an absolutely ridiculous price target for Tesla stock. Until it wasn't ridiculous anymore. In fact, Tesla stock has now exceeded Ark Invest's original price target. Yeah, that's right. The people everyone thought were completely fucking mad turned out to be a little bit bearish on Tesla stock. Can you believe it? Turns out, when somebody makes a prediction about the future that at the time sounds completely insane, and then it turns out that they were dead fucking right, it's usually worthwhile taking a look at how they reasoned their way to what seemed ridiculous and turned out to be inevitable. And that is exactly what we're doing in this video. I'll run through Ark Invest Tesla Stock Valuation Model, how they get to their price targets, what needs to go right, what could possibly go wrong, and more. And spoiler alert, yes, this does include the golden goose scenario, which split adjusted suggests Tesla stock could reach $4,400 per share by 2024. Not even joking. And just remember, the last time everyone laughed Ark out of the room, how'd that work out? So let's get into the video. But first, hey guys, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. That is an obnoxiously good return on your investment. I mean, really, deposit $100 and you'll end up with, at minimum, $21 worth of stocks, a 21% ROI on your money. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it. Tesla's potential trajectory during the next 5 years. In August 2018, Ark published an open letter with an extract of our Tesla valuation model communicating why we believe taking Tesla private at $420 per share would deprive shareholders of significant returns. Since then, Ark has updated its Tesla valuation regularly. Based on new research, we are sharing our latest model to clarify what we believe is Tesla's potential. By the way, I just want to jump in here quickly. For those of you that don't know, when Ark Invest originally published their research, their Tesla stock valuation model around that 420 tweet, their original price target for Tesla stock was $4,000 per share pre-split. That's $800 per share post-split. Guess what? Tesla stock passed $800 per share this week. Based on our updated expectations for electric vehicle cost declines and demand, as well as our estimates for the potential profitability of robotaxis, our 2024 expected value per share for Tesla is $7,000. Just got to jump in here just in case anybody doesn't know. These numbers are all pre-stock split, so divide by 5. $7,000 per share equals $1,400 per share split adjusted. Almost double from where Tesla stock is today. To arrive at that base case, Ark has developed a probability analysis with bear and bull price estimates as detailed below. We can see Ark Invest's expected value for Tesla stock, $7,000 per share, again split adjusted $1,400 per share. This projection is our base case for Tesla's stock price in 2024 based on our probability matrix. There's also a bear case which we can throw in the bin now. Tesla stock is well past that price anyway. And a bull case with $15,000 per share or $5,000 per share, split adjusted, and Ark suggests there's a 25% probability that Tesla stock will be worth $3,000 per share or more in 2024. Oh, and by the way guys, in case you don't know, this Ark Invest valuation model on Tesla stock is about 12 months old. Since then, Ark have become even more bullish on Tesla. Tesla's continued to execute better than expected, which means when Ark Invest updates their Tesla stock valuation model, all of these price targets are going higher. Mark my words. Shown in the following graph is our probability distribution for Tesla stock's price target. This Ark valuation on Tesla stock is broken into 25% probability segments. We've got the bear case over here on the left, which as I said, we can throw in the bin. Many of the potential outcomes there have been disproven, no longer relevant. In the middle here, we've got the median sort of price target of $2,700 per share, but an expected value of $7,000 per share. As Ark notes, the expected value is far greater than the median value due to the upside skew from autonomous, as in robotaxis, and this is very important. If we look at the bull case here, which Ark assigns a 25% probability to, Tesla shares trade at or above $15,000 per share. Split adjusted, that's $3,000 per share or more if Tesla solves autonomy. And in case you guys haven't noticed, Since Ark published this research, Tesla has begun to release full self-driving beta to an ever-growing group of Tesla users for testing and improvement. The software is improving at a staggering rate. I have absolutely no doubt that not only will Tesla solve autonomy, but they'll be the first company to do this and the first company to widely deploy autonomous driving software throughout their vehicle fleet. How did we arrive at these results? We'll explain the methodology below, focusing in the second half of this piece on the research that informs our assumptions. Key inputs. Ark's research and modelling suggest that three key independent variables are critical to understanding Tesla's potential. Gross margins. Will Tesla's cost of manufacturing vehicles continue to fall in line with Wright's law? If so, what will be the average selling price of Tesla's vehicles? Capital efficiency. What is Tesla's cost per unit to build new production capacity? And autonomous capability. Can Tesla launch a fully autonomous taxi service successfully? The table below summarizes the upper and lower bounds for each of these variables. So the top row here, the high end, we've got gross margins, capital efficiency, and autonomous capability. On the margins front, costs fall in line with Wright's law. Margins reach around 40%, consistent with a dominant brand that is an innovation cycle ahead of commoditized competitors. Shout out to Tesla. Guess what, guys? Tesla's margins are marching steadily towards 40%. Mark my words. On the low end, margins are in line with a premium automaker that owns its distribution and service centers and will stabilize at 25%. Spoiler alert. In Tesla's Q3 2020 results, we saw that their gross automotive margin exceeded 27%. In other words, that march towards 40% is well underway, and we can scratch this low end because Tesla's already got better margins than this is predicting. In terms of capital efficiency, we've got $11,000 per unit of capacity, which is $4,000 worse than the industry expectation for EVs and roughly equal to Tesla's Shanghai factory. As we know, Tesla continues to learn and improve in leaps and bounds, so I believe that overall Tesla's capital efficiency will become far and away best in industry by miles. Therefore, I think Ark may be a little bit bearish on this front, but hey, time will tell. At the low end, we've got an absolutely absurd $16,000 per unit of capacity, $2,000 worse than industry average. Please tell me some things that Tesla sucks at that they're worse at than the industry average, besides customer service and panel gaps. Exactly. And in terms of autonomous capability, on the high end, we've got fully autonomous driving commercially launches in 2021. Definitely a possibility. Tesla charges $2.50 per mile, falling to $1 while taking a 50% platform fee. I think this is a little bit bullish in terms of the timeline and Tesla's platform fee, but again, time will tell. But I have no doubt that Tesla will solve autonomous driving, and they'll be one of the first, if not the first companies on earth to be charging customers to use fully autonomous taxis that aren't geo-fenced, aren't using training wheels, and can go anywhere within reasonable bounds of a city, state, or an entire country. And on the low end here, we've got Tesla fails to create a fully autonomous car. Ark's likelihood 70%. Yeah, no way. I'm sure when Ark updates this research, this figure will be well below 50%. I have no doubt it's happening. Maybe Ark are being a little bit more conservative, but I'm confident to put this on record because I know I'll be right. I know Tesla's going to solve autonomy, and I know they'll be first. The valuation. Ark's valuation is based on 10 scenarios, each of them probability weighted. Our bull case for Tesla does not assume the most aggressive inputs for the three variables noted above. Instead, we estimate probabilities for each independent variable, resulting in 8 scenarios. We've also included 2 scenarios that encompass worst case factors. 1, a 3% chance that Tesla is unable to access the capital markets, lower costs, launch an autonomous taxi network, and become capital efficient. Good luck with that outcome. And 2, a 1% chance of a black swan event in which Tesla goes bankrupt. The only scenario in which I see this type of possibility playing out, really, we're talking like a 0.00001% chance. You know, extinction level asteroid impact destroys Tesla's Shanghai factory and kills Elon Musk. He happens to be on site at the same time. That could do it. But outside something like that, I really find it unlikely that even a black swan event can kill Tesla. I mean, look what happened during the pandemic less than a year ago. Tesla gained market share, as I predicted, as expected. So yeah, it's really going to take a lot to kill Tesla, and I really mean a lot. The resulting probabilities of the 10 different scenarios and their corresponding price targets are shown below. And here we are looking at the Ark Invest probability matrix for their Tesla stock price. We can see the 4 at the top here all include Tesla successfully achieving autonomous vehicles. The bottom half here, no autonomous achieved. But funny, interesting to note, The price target, the 2024 price target in the best case scenario in which Tesla doesn't achieve autonomy is less than $4,000 per share. Remember, Tesla stock has already exceeded $4,000 per share split adjusted, so we can basically scrap the entire bottom half of this probability matrix. No longer relevant. And I can't wait to see Ark Invest's new updated Tesla stock valuation model. Hopefully they'll release that soon. Not counting on it, but at some point in the future we will see that. And I suspect that their golden goose case is going to be way, way, way beyond where it was here. So let's just start at the top. The golden goose scenario. Tesla lowers costs, which they're doing very well at this point in time, builds factories efficiently, which they're also doing extremely well, faster, more efficient, more capital efficient than anyone else on earth. This isn't up for debate. These are facts. And launches its autonomous network. Again, I'm very confident that this will happen. Ark Invest is assigning this an overall probability of 12%. The 2024 price target based on the golden goose case, $22,000 per share. Today that adjusts to $4,400 per share. I suspect in the future, Ark's new golden goose case is probably going to put that stock price target closer to $6,000, $7,000, $8,000 or $9,000 per share. Yes, I'm serious, and no, I'm not high. Well, maybe I am, but it doesn't really matter because anyway, let's move on. The next scenario here, the autonomous builder. Tesla launches its autonomous network and builds factories efficiently, but can't lower costs. And I don't see this as a likely outcome. We've seen so much evidence over the past 12 months of Tesla continuing to drive their costs down further. I mean, we saw a recent 30% price cut in Model Y in China because Tesla had lowered costs. We've seen things like the gigantic gigacasting, octovalve, heat pump, blah, 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 blah. The point is, Tesla will continue to lower costs over time. This is not up for debate. The next scenario, the autonomous car company. Tesla launches its autonomous network and lowers costs, but can't build factories efficiently. Once again, this can also go in the bin. We've seen so much evidence now of how efficiently, how quickly, and how capital efficient Tesla is able to construct new factories and expand existing facilities. I mean, again, this is in the bin. I know it sounds crazy to be eliminating some of these very high valuation scenarios, but we just have to look at the evidence before us. Tesla is demonstrating their ability to do all the things that need to happen for this golden goose scenario. Next scenario down the list, autonomous over everything. Tesla launches its autonomous network, but can't lower costs or build factories efficiently. Again, these are in the bin. We know Tesla can. So where does this leave us? Well, I hate to say it, this sounds kind of insane, but the golden goose scenario now seems like the base case for Tesla stock. They are going to lower costs, they are going to build factories efficiently, and they are going to launch their autonomous network. In all cases, except those in which it is either denied access to the capital markets or is bankrupt, we assume that Tesla issues $10 billion in equity capital to scale production at an accelerated rate and capitalize on its competitive advantages. Just jumping in here, in case you don't realize, Tesla did exactly that, raising around $10 billion by issuing stock in the past 12 months. Fancy that. Ark once again forecasting the future. We also anticipate that Tesla will issue incremental debt, tens of billions of dollars in some cases, to scale production, and that the issuance will be governed by its profitability and collateralized by its fixed assets. Based on this probability matrix, our bear case implies that Tesla will sell 3.2 million vehicles in 2024. I just have to jump in here and just point something out. Yeah, Ark Invest's bear case, Tesla selling 3.2 million vehicles in 2024. Meanwhile, you have numbnut analysts on Wall Street who are still estimating 1.7 million vehicles sold in 2025. In case you guys haven't noticed, I have no qualms in sharing my thoughts and opinions, nor in ridiculing the ridiculous, which is exactly what I see when Wall Street analysts share their estimates for Tesla's future deliveries. I'm not here to be a douchebag, but I do have a real issue with incompetence and stupidity which seem to be on full display within many of the Wall Street analyst firms trying to estimate Tesla's future vehicle sales. I'm not being a dick here, I'm just pointing out the facts. These guys shouldn't have jobs, they shouldn't be talking, and they're going to be very, very, very embarrassed by their research in a few years' time. Based on this probability matrix, our bear case implies that Tesla will sell 3.2 million vehicles in 2024, cutting its share of total EV sales roughly in half compared to today's levels. Our bull case implies that Tesla will maintain its roughly 18% market share and that a substantial percentage of its fleet will generate high-margin robotaxi platform fees. And in case you haven't heard, the latest data shows Tesla has in fact maintained and in some areas grown its market share. Kind of incredible, but the facts are the facts. And here we are looking at comparisons of the bear case and bull case for Tesla stock in 2025. The company, they're looking at selling 3.2 million vehicles in the bear case and in the bull case 7.1. Average selling price much higher in the bear case, lower in the bull case. Wait, you might think, why would that be? Good question, because in the bull case, Tesla continues to lower their costs, which means their market expands. Lower overall average selling price, but much larger market. While these assumptions might seem far-fetched, please consider the following research. Gross margins and Wright's law. We believe that gross margins are key to Tesla's viability and value. In the fourth quarter of 2019, Tesla reported auto gross margins of 20.9%, excluding regulatory credits. Based on Wright's law and expressed in Ark's model, Tesla's auto gross margins could approach 40% in 2024, though they are unlikely to increase in a straight line as new models launch and production scales. I agree with all of these points, especially the 40% margin by 2024. Tesla inevitably gets there. The question is, does Tesla maintain a high margin on their vehicles or a slightly lower margin in terms of the vehicle sales because they know they'll recoup a lot more of that on software revenue? Wright's law has forecast cost decline successfully in more than 60 technologies ranging from solar power to televisions and from semiconductors to ovens. As shown below, Tesla's Model 3 has already demonstrated cost declines in line with Wright's law. And we can see here the Model 3 cost decline curve mapped onto Wright's law. So far, so good. The auto industry has scaled in line with the cost declines predicted by Wright's law for more than a century. As shown below, Ford's costs have tracked the declines predicted by Wright's law since 1903. And we can see here Ford's costs, those purple dots, following the cost decline curve modeled out all the way to 2018. Over 1 century. Fancy that. While Ford's costs appear to have stabilized, Tesla's costs should continue to decline during the next 5 years because the internal combustion engine is a technology far more mature than the lithium-ion battery. A mature technology seems to stop declining in cost because of how long it takes to double production from a large base. Globally, automakers have manufactured roughly 5.4 million EVs to date, less than 1% of the 2.6 billion internal combustion engine vehicles ever produced. Even if the production of ICE vehicles was stabilized at roughly 90 million vehicles annually, the cumulative doubling would take 29 years, much longer than the roughly 1 to 2 years likely for a cumulative doubling of EV production. In addition to our Wright's law analysis for vehicle production costs, Ark's model drops the average selling price for EVs selling at higher volumes. In the bull case, Ark estimates that Tesla will be able to attain only 15 to 20% of the addressable market for each model. At their peak, the combined sales of the Model S and X commanded roughly 20% of the premium vehicle segment. And looking at this chart below, we can see Ark's estimates for vehicle total addressable market by different categories: premium luxury vehicles, pickup trucks, etc. Total addressable market in purple, and Tesla's share of that capped at 20% in black. We can see we've got the Model S and X for the premium luxury vehicle, Cybertruck in pickup trucks, Model 3 in luxury sedan, Model Y in luxury SUVs, and look at this, mass market sedan, mass market SUV. Guess what, guys? Tesla's $25,000 vehicle, that's what we're looking at here. Capital efficiency. Capital efficiency sparks and accelerates the Tesla flywheel. If expanding capacity is prohibitively expensive, then the cumulative doubling of production necessary to lower costs, generate cash, and reinvest in expanding production becomes uneconomic. If Tesla were to be capital efficient, then it could expand production rapidly and affordably, lowering unit costs, increasing returns on invested capital, generating cash for future factories, and attracting more capital, all of which we've seen play out throughout 2020. Ark assumes that Tesla will be more capital efficient than traditional automakers. The amount of capital required to produce a car powered by an internal combustion engine in the US has been rising steadily. Guys, if you're making a vehicle using technology that's over 100 years old and the cost to do that is increasing over time, you're doing it wrong. Just saying. Anyway, in the last 5 years or so, the auto industry has invested more than $14,000 in fixed assets for every car produced per year. With a fraction of the moving parts, electric vehicles should be manufactured much more efficiently than gas-powered cars. Indeed, Ford and other automakers have suggested that EVs could be produced at 50% of the capital investment necessary for gas-powered vehicles. A straightforward calculation, 50% of $14,000 suggests that an EV factory could be built for $7,000 per unit of volume capacity. Ark's high-end capital efficiency scenario. In our capital efficient case, we assume Tesla will be able to build factories for $11,000 per unit volume of capacity. For context, Tesla confirmed that $1.6 billion in financing was necessary for its Shanghai factory, which will have an initial capacity of 150,000 vehicles. If 1.6 billion were to net 150,000 vehicles, the cost per unit of initial capacity would be roughly $10,700 before increasing productivity. I just want to point out now, guys, that the Shanghai Gigafactory is already ramped to over 20,000 vehicles per month, over 250,000 vehicles per year, just for context. Ark's low-end capital efficiency scenario. According to our model, if it were not capital efficient, Tesla's cost per unit of capacity would be $16,000 or $2,000 higher than the gas-powered auto industry average today. And the probability of this scenario playing out in my mind, 0%. Autonomous execution. Geez, autonomous execution. That sounds like a Boston Dynamics meets Black Mirror meets AI gone wrong scenario. Anyway, autonomous execution. A fully autonomous taxi network could break the mold of a traditional automotive manufacturer's business model completely. Tesla could shift from a model of one-time transactions at hardware-like margins to a model of recurring transactions at software-like margins, charging passengers per mile and taking a platform fee. In other words, this is Tesla's future money printer. Extremely high margin software revenue spread throughout a fleet of millions of vehicles, aka users. Ark's high-end autonomous execution scenario. Initially, Tesla could set rates comparable to the $2.50 per mile that Uber and Lyft charge today, dropping them to $1 per mile in 2023. We model that Tesla will take a 50% cut of gross revenues from autonomous taxi networks, much higher than the 20 to 30% cut Uber and Lyft enjoy today, based on the additional convenience, improved safety, and cost savings, as well as Ark's analysis of platform fees in other markets. We also assume that its autonomous taxi service will begin in 2021, 1 year after Elon Musk has predicted the service will be available, regulatory approval permitting, with just 2% of eligible Tesla vehicles on the network in its first year. I have a very high level of confidence that by 2022, Tesla will have launched their robo-taxi network in at least some regions. It's possible 2021 happens as well, and I think it would require train wreck after disaster for this not to launch before 2023. Worst case scenario, worst case scenario, Tesla robotaxis are available some parts of the world, 2023. Most likely, I think though, 2022, and maybe it even happens this year. Let me know in the comments below, when do you guys think Tesla will first launch their robotaxi network somewhere on planet Earth? In previous versions of our valuation model, Ark assumed that the cash generated from autonomous taxis would build on Tesla's balance sheet. In this version of the model, Ark assumes that Tesla will invest any incremental cash in additional factories to scale EV production capacity and accelerate the world's transition to sustainable energy, consistent with this mission statement. I wholeheartedly agree with Ark here. Unless Tesla is constrained by cell supply or something like that, they will put every spare cent they possibly can back into driving costs down and increasing production to get more Teslas on roads, to get more battery packs on homes, and to get more solar on rooftops. Ark's low-end autonomous execution scenario. If an autonomous taxi network never launches, clearly it will generate no revenues. That got me. No shit, Sherlock. Good job, Sam, by the way. I'm sure Sam Korus, when he wrote that, thought he'd have a little bit of fun. I mean, well played, so. As shown below, the full picture of the flywheel should become clear. An autonomous taxi network should provide Tesla with capital to invest in factories to produce more vehicles, which should lower production costs and expand Tesla's autonomous fleet. And here's the Tesla flywheel. Investment in Tesla factories means more autonomous Teslas, means cash generation from autonomous taxi network, means more investment in Tesla factories, That's what the flywheel is. Hope you guys have enjoyed this video. Truth be told, I know a lot of you are lazy motherfuckers and can't be bothered reading any of Ark's research, but you'll happily sit there and watch somebody on YouTube read it and share their thoughts and opinions. It is what it is. I'm not judging. I just want to share this information because I think it really matters. As I mentioned earlier, this research is almost 1 year old. In that time, we've seen a huge amount of evidence that skews heavily towards the bullish scenarios. Tesla has continued to improve their margin, improve their capital efficiency, grow their fleet, pull further ahead in terms of winning full self-driving and eventually releasing autonomous robo-taxis, and plenty more. I can't wait to see Ark Invest's new, updated and most current Tesla stock valuation model whenever they publish that research. And I have a funny feeling the scenarios that we saw in today's research, the golden goose scenario, $4,400 per share split adjusted, which is exactly 5 times what Tesla stock closed at on Friday afternoon, is going to look like chump change. In fact, just for a little bit of fun, let me know in the comments below, once Ark Invest updates their Tesla valuation model and shares it with everybody, what's going to be their upper limit Tesla stock price target, their new golden goose scenario? Keeping in mind that today, split adjusted, their old golden goose scenario based on this research, which is almost 1 year old, is $4,400 per share. This was before we saw evidence that Tesla has maintained market share, continued to drive down their costs and improve their margin, and has become even more capital efficient. I would let you guys know my guess, but I don't really want to taint the results, so maybe I'll just sum it up like this. I think Ark Invest's new golden goose scenario price for Tesla stock is probably going to be approximately 1 or 2 metric shit tons more than it was in the recent research. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. PS, if you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.